This video is brought to you by HalloCasa. Our tool transforms independent local real estate agents to global real estate agents. Create your own profile for free and get contacted by international investors. Sign up with the link in the description. Hello and welcome everyone to our 149th session of HalloCasa. My name is Michael and today I'm talking to Paul Moore from Lynchburg in Virginia. Paul is managing partner and founder of Wellings Capital. His firm manages over $330 million in assets, helping investors grow their wealth through passive investments in recession-resistant properties like self-storage, mobile home parks, and multi-family units. Paul, thank you so much for your time and for being on the show. I'm very honored and pleased to have you on the show because you have a huge track record. You have built a lot of shareholder capital. I love your approach regarding investment. I love your distinction between speculation and investment, also entire nonprofit approach, your books and everything else around it. Someone who, in my opinion, even before talking to you online, is an example of a very successful human being. Apart from that, also having a very healthy family with raising 4 children. Paul, welcome to the show. Why don't you introduce yourself to our audience?
Yeah, thanks, Michael. I actually was at Ford Motor Company and I got bored. I started investing in side ventures and quit Ford after about 5 years back in the early 90s. We started a company and we were very blessed to be able to sell it in about 5 years after that to a publicly traded firm. And I thought, hey, I'm a full-time investor now. And I wasn't. I figured out years later after losing a lot of money that I was not an investor. I was a speculator. You know, investing is when your principal is generally protected or should be protected, and you've got a chance to make a return. And speculating is when it's not protected at all and you've got a chance to make a return. And I didn't know the difference. And so I made a lot of money doing that, but I probably lost more money. And then I started investing in real estate. We flipped a lot of houses. We flipped a bunch of lots at a beautiful resort called Smith Mountain Lake in the Blue Ridge Mountains of Virginia, and built some houses. And then we started a multifamily syndication firm. And we tried to do that, but it started to feel like speculating again. You know, the prices were going up so high and the risks that people were taking were so serious that we decided we did not want to be part of that. So we pulled back and we started a fund. And our fund, we are on our 6th fund now. And our desire is to find the very best operators of self-storage, mobile home parks, RV parks, multifamily, and more. And we invest in their deals, and we hopefully give our investors income and growth along the way, though there's no guarantees.
How do you define exactly investing regarding your principal is safe? How can I imagine that? I understand that I invest something, it can happen something. Yes, I invest into the bank, I get like 2%, 1%, 3%. It depends on the interest rate. It's basically sort of safe. How do you, as a fund, from your category and also from your entire concept, make sure that this is safe to the investors?
Yeah, that's the most important thing we do, I think. We do a tremendous amount of due diligence on operators, first and foremost. We want to find operators who are really similar, you know, who have a similar mindset. These are operators who used fixed debt instead of floating rate debt. These are operators who don't take on too much leverage. These are operators who have a long track record and a wonderful team, and they're not overreaching when they buy properties, and they're not assuming, you know, that everything has to go right to be successful. And so by partnering with the right operators, that's the best way we protect our investors' capital. A lot of the mistakes that have been made have been from over exuberance and from marketing firms, people that are really good at raising capital, really good at marketing. They hold out shiny objects to their investors. And here's the thing, when everything was going up, the rising tide lifted all boats. Those people made the biggest gains because they took the biggest risks. But when the tide went out, Warren Buffett said, someday the tide will go out, then we'll see who's skinny dipping. And that's what happened when the interest rates rose 11 times in 2022 and 2023. The tide went out, and a lot of those people got caught in big trouble. And the people who took the biggest risks then had the biggest losses, and we've tried to avoid them. And by doing that, I mean, we looked at 515 operators in 2023. We only invested in 11. And by doing that very carefully, this is the best way we can protect our investors and their principal.
I understand. Thank you so much. Basically, all the others, they're over leveraged. There is no collateral, and they're just trying to do it for appreciation purposes. The way I understand it is that you do it more like for the cash flow and make sure that you are investing into something which is already a running business and already generating positive free cash flow, or you have unidentified potential for it so that you can flip it properly and market it. Give me an overview how do you define an operator? Maybe that's something which is straightforward to you, but maybe also for the audience. Is it the owner, or is it someone afterwards taking care of the unit which you are selling?
Yeah, these could be called operator, could be asset manager, could be syndicator. This would be a company who's an expert in, RV parks or self-storage or light industrial. They have years of experience. They know how to evaluate the deals. Most of them have had problems in the past, and they learn through those mistakes and that pain, just like we did. And they're the ones finding the deals. They're the ones raising the money to go buy the deals. They're the ones with the property management, or at least they oversee the property managers. They're the ones taking the debt and signing on the debt in their name. And then we invest with them.
Regarding RV parks, I am in Europe and we don't have the concept as much as in the US. What is it exactly? I understood it from my ignorant point of view that it's locations where there's a land, there's a farm, and then people live on that in an RV, and there's a huge entire camp. They do that either seasonally or they do that long term. Can you maybe clarify that to the global audience?
Yeah, no, you're right. An RV would be a recreational vehicle, and so that would be a mobile, a housing unit that you can sleep anywhere from 2 to maybe 8 people in, depending on the size and the layout. And people drive them from location to location. And these RV parks have various services. Some of them might have only a camp site, a place to pull in your camper. RV is also known as a camper. You can just pull it in and you can just park there for the night. And we did that in Alaska. My son and I, we paid like $20 a night just to pull in and just camp. Then there's other parks that have, water, sewer, electrical hookup. And sometimes some of the campers, the RVs don't need that because they're self-contained. They have the water and they have they have a generator and all that. That's what we had. But then you can go to some parks that have electrical, water, and sewer hookup. They might have restrooms, and they might have other basic facilities like a picnic table or, a lake or something like that. And then there's a third type. There's the full-blown, almost like an amusement park. So some of the ones we've invested in have, lakes for swimming and then a separate lake for fishing. Might have a restaurant. It might have, all kinds of children's activities like face painting, and might have swimming activities. There's something called Wibbits. Wibbits is a big recreational obstacle course out on a lake, and the RV park might charge $17 per hour for the kid to play on that, and that's quite a nice value add. Some of them have pet facilities. Some of them have all kinds of fun things to do that some of them have like a $2 or $3 million water park attached to it that's part of staying there. Some of them have, cabins. And, if you don't have an RV, sometimes somebody might have an RV and they want to bring their relatives or friends, and their friends stay in the cabin next door. They have all kinds of fun things like that. So that's more of a full-blown amusement park, RV park.
How do you make sure that you are identifying good opportunities in this category?
Well, again, similar to the question about safety, if we are investing with an operator with a great team, great track record, they have a lot of their own money in the deal, then, the debt is, it's not too high debt, not too high leverage. They're not making too high of assumptions. We stress test the numbers to make sure if things go wrong, we'd still be safe. We have terms and conditions built in for us to potentially step in if the manager is failing. Those are some of the ways we, identify the opportunities. And of course, then the operator, they're responsible for doing the due diligence on the location and the metrics, and really, building and managing the property appropriately.
Regarding mobile storages, tell us about this concept, what we can imagine there in order to invest and also make, flip it and make it profitable.
So these would be self-storage assets, right?
Mm-hmm.
Yeah, so self-storage, I actually wrote a book on self-storage called Storing Up Profits, and it was published by Bigger Pockets Publishing. Bigger Pockets is a large website based in Denver, Colorado, that people go to learn more about real estate investing. There are about 55,000 self-storage facilities in the United States. There's some in Canada, hardly anywhere in the rest of the world, but they're starting to grow in England, I've noticed. But basically, Americans have too much stuff and they don't want to get rid of it. And so when my mother moved, when she significantly downsized from a very large apartment to a tiny apartment, she put a lot of her stuff in storage, and it's still sitting there. And all that stuff is there. She's paying, like $250 a month to store all this stuff. And basically it's relatively easy to manage a self-storage facility. There's no toilets. They don't have live tenants. They don't have people fighting. They don't have, they don't deal with all of the terrible difficulties that multifamily operators have to deal with, or mobile home parks. And these self-storage facilities, they have all kinds of value add opportunities. Some of them have land attached to them. You can, do boat and RV storage. Some of them have an opportunity to build up, like to build vertically and build a larger facility. There's opportunities to put in, propane filling stations, ATMs, cell towers, billboards, opportunities to sell retail items like locks, boxes, tape, and scissors, packing supplies, things like that. So there's all kinds of upgrades that a professional operator can do at a self-storage facility that can really make investors money and give them safer principal.
Do you see the market growing because of a higher divorce rate, more singles needing or not having basically the real estate to store all their belongings in a
Yeah.
smaller apartment, therefore going for such a self-storage facility?
Yeah, that's a very good point. A lot of people who are, when they get a divorce, sometimes they need storage. A lot of people, when they're moving, they need to storage temporarily, and that often turns into long-term. Sometimes somebody gets storage for 3 months and it turns into 3 years or longer. Um, as baby boomers, my generation, passes away, a lot of the kids, they put their parents' stuff in self-storage, and sometimes they keep it there for years.
Let's talk about your company. You already gave us a good overview of your services. If I'm interested in investing along your company, how would that be? What would be the process? Do you have any requirements there?
Yeah, our investors are accredited under the Securities and Exchange Commission standards, which means that they're essentially making enough income or they have enough wealth that the SEC believes that they're qualified to make good decisions. These investors, they typically, hear a podcast like this, or they read some of the literature. They might read one of my 3 books, and they would, contact us. We get to know them. We see if they seem like a fit for us. They see if we're a fit for them. And then they typically make a decision, and the minimum investment with us is $50,000.
Do you have a lock-in minimum time that I have to leave the money there, or can I not pull it out at all? How does that basically work, the conditions there?
We do a lot of things in conjunction. We try to follow Warren Buffett. If Warren Buffett if his company, Berkshire Hathaway, if their stock lost 99% of its value, it would still beat the S&P 500 by 40% over the last 59 years. And so Warren's pretty smart. And he said, I wouldn't invest in anything for 10 minutes if I wasn't willing to leave it there for 10 years. He also said, my ideal holding time is forever. So we've actually settled on 10 years. So our average investment in our funds is about 10 years. And that is locked up for that time because it's not easy. It's not like we can just redeem those shares. We can't sell a piece of the real estate to give somebody their money back. So it's a 10-year lockup. And we're trying to get investors who have a similar mindset. Now, that said, we do have we have single one-off investments from time to time that would be more like 3 to 4 years.
Now, talking a little bit about your podcast, I love the name first and foremost, How to Lose Money. And you had the last episode in 2020, unfortunately. You interviewed many people, and I actually had a look on it and had a listen. It's very interesting. What motivated you then? What also maybe are your key learnings there, interviewing and talking about it?
We came to the conclusion in 2016 that we learned a lot more from our mistakes than from our successes, and it was a lot easier to not repeat someone's dumb mistakes than it was to repeat the good things they did to get, to attain success. So we decided to start a podcast focused on people's pain, losses, failures on the way to the top. And by doing that, we were able to really get in touch with, help people realize what not to do. Like what I told you, what I did wrong. One of the many, many things I did wrong was speculate. But anyway, so we decided to call it How to Lose Money. We interviewed 238 successful people over 4 years, and we had a lot of fun doing that.
You're also a book author. You already mentioned one of them. Give us an overview of your motivation there, and also, what you're basically conveying in those books.
Yeah, so when I discovered multifamily syndication and the power really of all commercial real estate to build wealth, and I discovered that a high percentage of very wealthy people have commercial real estate. I realized, I said, this is amazing. This is like the perfect investment. And I realized that, in residential real estate, the value is based on comps or comparables. What else is selling in that neighborhood for what price? But in commercial real estate, the value is based on math. And that math equation is the value equals the net operating income divided by the cap rate or the capitalization rate, which is kind of the going rate of return for that type of asset at that location at that time. Well, we thought, wait a minute, that means we can force appreciation. You can drive forward appreciation just by increasing the net operating income. And so when I realized that, it was like a light bulb moment. So I wanted to write a book about that, and it was called The Perfect Investment. And it was, it was specifically about multifamily investing, but it applies to almost all commercial real estate because that's how the math works for all commercial real estate. That came out in 2016, and Michael, I realized after I told you earlier that multifamily got overheated, and so I actually went on lots of podcasts and wrote lots of blog articles after that and said, time out. It's not the perfect investment if you have to overpay to get it and take too many risks.
Let's talk a little bit about your nonprofit activities. You're very involved in supporting Aim Free, an organization against human trafficking and also modern slavery. Give us an overview there, what it is about, and also how you're contributing.
Yeah, did you know if you took not average, the record profits of Nike, ExxonMobil, and Walmart, their record profits, and you added those together and you tripled that number, that's the approximate profit from human trafficking every year. There's over 40 million people trapped in human trafficking, and hundreds of people have been sold or captured into this form of slavery since we started this podcast. And so we didn't think that was okay. So we decided, just like in commercial real estate, we want to do due diligence and see who the best people to invest with are. Well, we decided that we would do the same for nonprofits. And so we came up with an organization called AIM, AIM, and their website is aimfree.org. And we are trying to raise awareness about this evil, and we're trying to raise money to help AIM save and rescue more children. They rescued 62 little girls in their most recent raid and put 7 bad guys behind bars. And this is in Cambodia. And so we're really encouraging people to go to aimfree.org and contribute. We've raised over $600,000, raised and influenced and donated over $600,000 in the last 3 years. And we're working on it again this year, hoping to get even more.
Going back a little bit to your business and also entire experience, what was the worst day professionally in your life where you say, I thought I had everything sorted out, everything planned, and it was actually a nightmare? Do you have any example there?
Oh, there's so many. It's hard to tell you which ones, but I was investing with investors' money from 2004 to now, so that's 20 years. But in 2018, we had invested in a multifamily project. We were the operator in this case. This is before we started the funds, Michael. And we realized that we had failed to, really take into account the age of these properties. It was 1962 properties, and the wrought iron pipes under the buildings were, at least 1 or 2 were failing. And we got really nervous, and we decided to sell the properties at a small loss. We actually went to all the investors and we did a vote. All of them except one voted to sell, take the small loss, and move on. That was extremely painful. What we did is, it was hard to look in the investor's eyes like this on Zoom and say this, but I said, if you'll trust me with that money, that we get back. They got most of the vast majority of their money back, but not all of it. I said, I'll reinvest it and I will give you a written guarantee that I'll make that profit back for you and more, or I will pay you out of my pocket in 10 years. And so a lot of them did that, but it still was very painful.
Do you have any thoughts and conclusions, final thoughts we haven't talked upon? You gave us a very good overview regarding your first trajectory going into real estate. You gave us a very interesting overview on RV parks and also the storage, and basically also the entire investment scheme on the entire investment program, back to also even your NGO work and your books and stuff.
I would encourage.
Is there anything you would like to share with the audience?
Yeah, I would say this: unless you have a particular, a large amount of time on your hands and a lot of time to do due diligence, it's really smart that you don't invest with the first operator or the first investment opportunity you see, but you go really, really deep and do deep due diligence, find the very, very best operators with the best track record, and then do not only due diligence, but also diversification. Get a broad spectrum of assets across different operators, different geographies, different strategies, different time frames. You put the deep due diligence and diversification together, and I think you'll have a really good opportunity to be safe, make income, and profit.
Perfect. Well, thank you so much for your time today. Thank you so much for your final words. Again, it's been an honor to talk to you, and I send the best regards to Virginia.
Same to you, Michael. Thank you so much. Thanks to your audience. Hope you have a wonderful holiday season.
Thank you. Bye-bye.
Bye-bye.
This video is brought to you by HalloCasa. Our tool transforms independent local real estate agents to global real estate agents. Create your own profile for free and get contacted by international investors. Sign up with the link in the description.